Welcome to the May Investor Advisory Review. Hopefully you're having a wonderful day today, and I'm glad you could join us. And I'm looking forward to sharing some new information with you tonight. Some of the things that can help you as you work to create, grow, protect, and preserve your family's wealth in today's economy. This is your financial journey, and so our goal is to help you to be able to make the most of it and accomplish the return on life you're looking for. As always, a reminder of the important disclosures that identify items like the modeling that we do isn't a guarantee. If we're talking about tax ideas, you need to make sure that you're visiting with your accountant about that. If we're talking about legal issues or estate design issues, you certainly need to talk with your attorney about that because we're not able to give legal or accounting or tax advice, but we can certainly share information from experience we've seen, but it should always be checked with your critical resources you use. Everything that we talk about here tonight is designed to give you the information you need to make wise decisions. And as a fiduciary who tries the very best we can to make sure that we're helping clients think through the process wisely, we love to work with your other advisors to help bring about the best result for you. We'll take time for questions here. If I see questions come up in the middle of the presentation, and it's at a good spot, I may take them then, but for certain, we will take the questions at the end as well, for sure. So tonight we're going to cover a little bit different. I've kind of identified that at this moment in time, the economy and the markets are sort of maybe taking a breath a bit. I know that some of you are more concerned than others, and we'll talk about that briefly, but I'm going to spend some time tonight after we go through the market and economic review talking about the three curves of your retirement journey. Also want to talk about how wealth advisory, fiduciary wealth advisory, requires a dynamic financial planning strategy. And then also navigating your retirement successfully with ROL. We'll take some time to go over some of the thoughts that I had as a result of preparing tonight, and then remind you some of the resources we have available, go over your questions, and then remind you of the next review that we have coming up. This slide I've shown you, and we typically go through this slide, especially when people are concerned about the economy and the markets. Again, as we've talked before, GDP growth really is more of a plus at this point in time, not a plus minus. It is estimated, and we're watching to see whether we're going to have a recession. I was listening to some of our resources earlier today, and they were thinking there might be a steep recession. Others we talked to seem to think there's going to be more of a shallow recession. But regardless of which way it goes, we will be on top of that with you to help make wise decisions. Business profitability, there has been some slowdown in some aspects of the economy and the industry in general in those business sectors. And so we're giving it a minus right now. Again, I think as corporations look at layoffs and they look at higher interest rates, their profitability is a little bit stretched by that. But again, that is part of the ebb and flow of economic environments. Unemployment rates, though, tend to be still pretty good. Matter of fact, if anything, there's more underemployment, people looking for jobs, but there's more jobs than there are people at this point in time. And so we see that even with some of the layoffs we're finding. But small businesses in America seem to be really struggling to get people to come in and work and be consistent and persistent in that effort. And then finally, interest rates, again, a plus minus. They're not terribly high, although I know they're higher than what they were, 500 basis points higher than what they were a year ago. However, that's a plus sign for cash reserve accounts. It's a plus sign for seniors who are looking at CDs that they haven't seen for a while. And yes, it's a minus for businesses who are having to borrow money for other work they're doing. But putting the two together, I give that a plus minus. Now, I know from just last week and yesterday as well, that some clients are concerned about the looming debt issue for the country. My encouragement right now is don't worry about that. It's not that it's not an important issue, it is, but we've been here before. I think my biggest concern, quite honestly, is that if there is a problem with the debt, it's going to be more in the sense that the debt plan may cause the bond rating agencies to determine whether the U.S. is still as creditworthy as they were before. If you go back to the late 2000s, Moody's downgraded America's corporate rating, their government rating, I'm sorry, on the bonds. And quite honestly, I was very disappointed in that. We had a pristine AAA rating, and they lowered it. It hasn't come back up since. And I'm really hoping that Congress and the administration can put together a good plan to create a good confidence, a strong confidence that we have the ability as a country to pay back any debts that we make. I do believe that there might be a stalemate, and that it's possible we might see the government say they're going to shut down, but I don't really think they will. And quite honestly, if you look at the details of how they have operated in the past, when there has been moments like this, nothing essential was turned off, and it really was more of a I don't know, kabuki theater, if you will, trying to scare people. But in the end, the government's going to keep all of the essential items running. They have controls in which they can do certain line items and make sure those things keep running. They also have the ability to do a continuing resolution, a CR, that could make it so that the debt ceiling could be negotiated out several weeks or even months before it's finalized. So again, for those of you that are concerned about debt and what's going to happen with the country, I would say stay tuned. That's what we're doing, watching a lot of information. And if anything comes up that I think is problematic or derogatory, we will certainly be in touch with you to have that conversation. For now, though, I would say that with the pluses you see on the screen and the plus minuses and the one minus, we're still flying okay. Time will tell whether or not we're going to have a bigger problem down the road, and we will be on top of that with you. If I'm looking at the markets in general, the S&P 500 as a broad index, I would point to a couple of things that we're seeing that are slightly different than last month. One is that the narrowing here between the top line and the bottom line, the floor of resistance and the ceiling of support, is getting tighter. We do see that it is getting higher. We see the top line getting higher, and we certainly see the bottom line getting higher. So the floor of support is continuing to rise more rapidly than the ceiling of resistance. And as I've told you many times before, what's going to happen here is that this will tighten up, and then at some point it's either going to break down through the floor of resistance, or of support, I'm sorry, or it's going to break up into the ceiling of resistance and go higher. Based on what we're seeing in the economy, I think I probably would lean more towards it's going to break up and go higher, but we won't know until we get more data, because every day is a new day. Every day the information comes out and changes how that information is being perceived or read. And so at this point in time, I would say that we can look back going to, say, February, and we can see that there has been improvements in the market and the economy since January. We can certainly see some nice growth offsetting some of the downturn that we had last year. And when I say we, I mean the country, investing in general, and even for some of you, your portfolios, we can see significant improvement. The question, I think, on all of our minds is it going to continue? And if it doesn't continue, will it be a steep decline or just a volatile, shallow, maybe straight across, but with a lot of volatility attached? As always, stay tuned. We'll continue on that discussion as well, but I don't think that there's anything significant to cause me concern to say anything's different from the last month or two that we've been talking. When we take a look at managing your portfolio during challenging times, it's, as always, diversification, 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 wanting to make sure that we have the assets balanced out per your risk tolerance, per your reward needs, your growth or income goals. And so we do that by working with all of the circles on here, the cash reserve accounts, the bond investments, equities or stocks, real estate programs, tangible assets like energy, metals, commodities, currency. We've had some nice opportunities with currency in the last year or so, and I think that may be changing in time as we see interest rates begin to adjust. But that's been nice. Business interests, had some different things that we've been able to do with people. Those have been great opportunities as well. Many of these things have been great opportunities, and using diversification, not putting all of our eggs in one basket, has helped to minimize downturn in certain economic environments, and then provided some upswing that has been also wonderful. But just like all of you, we're watching carefully to see if we need to make adjustments with the portfolio. There is no perfect answer for any portfolio management, and if the markets go down, we will do everything we can to minimize that downturn and take advantage of any opportunities that show themselves as we go further down the road. For now, we are holding as we are, but we have been making some adjustments into some more conservative investments that pay higher interest rates, since that's one of the opportunities we have. And for many of you on this call, we've been talking about those things. I've shared this slide the last few times because I think this is an interesting slide. For those of you who remember last month, I think I even touched on it the month before, the circle of knowledge that we all possess. If everything that represents the knowledge that is possible in today's world is inside of this circle, we all have things that we know to be true, things that we don't know, and we all have blind spots, things that we don't even know that we don't know. And as we learn, change, and grow, we find that some of the items that we believe to be true turned out to be false, and we make adjustments accordingly. And as we continue to learn, change, and grow, we find some of the things that we didn't know, we learn new information and expand our thinking. That happens from 3 points. The way we expand that knowledge is 1, the places that we go, those experiences that teach us new things. 2, the things we read, our own personal study. And then finally, the people we meet. And while I would say that I have learned a lot from my experiences and I've learned a lot from personal study, I would also say that the people we meet are the ones who sort of expand that box faster. Hopefully, your experience with us is that we're helping you to expand that box faster. I think that's why many of you who join us on the regular monthly investor advisory or wealth advisory review is because there's information that we're sharing with you that helps you expand your knowledge. I would also say that some of you, you come to me and say, hey, what about this? And sometimes I find that information fascinating. The information you share with me transfers knowledge to me as well. And so it's one of the things I encourage every client to let us know what you're running into out there. That's why I think many of you ask questions of me and what's going on in the economy, and I share information with you. And I definitely appreciate it when you share with me, because we're all looking to make the best decisions we can to manage wealth wisely for ourselves and our families. That brings us to the 3 phases of your financial journey. I would point out that, as it says up in the left corner there, direction determines destination. That's why we are constantly trying to identify the direction that's going on, whether it's with the markets in general or the economy, your portfolio, or how it works when you look at your retirement, either pre-retirement or post-retirement. Because if we can understand where we're headed, it can give us some indications on what that destination is going to look like, and we can decide if we like it or not. For those of you who are pre-retirement, the accumulation phase, you're building wealth to get ready someday to plant that flag at the top of the mountain and say, I'm ready to redirect or retire. For those of you who've already planted the flag, you're in the post-retirement area, you're decumulating. And what you're doing is you're pulling money out to live life. You maybe are just starting in retirement, so you got the sequence of return risk that you're dealing with. And as I've talked before, we try very much to help you think through how do we minimize any potential downturns that might happen in the economy that might force you to have to go back to work. That's not anything any of us want to happen. As you go further through retirement, we have EOL, end of life risk, that we have to consider. We want to make sure that we have thought through health issues, final issues, how to handle things if we have incapacitation. End of life risk is another component that we want to make sure we thought about. And then you'll see there at the bottom your desired return on life, or ROL. We want to make sure that as each of us prepare to check out, to assume room temperature, to go meet our maker, that we have really thought through our desired ROL. And as we take those last few breaths of air on this planet, we can say, I have done what I'm supposed to. I feel good about what's happened, and I am pleased with how things have worked. It won't be your desired ROI, return on investment. Of course you want that. We all want that, and that's a critical component of ROL. But really, in the end, it's not going to be I made 10% list last year and then we take our last breath. It's going to be more that we did the things that we believed were important, the things we were called to accomplish, that made life better and made what we're doing in people's lives worthwhile. And then after that phase, we move into the transfer phase, where we transfer assets to our loved ones and the groups that we care about that we think are making a difference on this planet. So as you go through this material with me tonight, I want you to think about some of your desired return on life items that are important to you. Some would call that a bucket list, and we'll come back to that in just a moment. So let's take a look at the curves of your retirement, because understanding how the curves of your retirement work make it easier to make good decisions as you go forward. As I've shared with you over the last year or so, we have really worked hard to create a fiduciary wealth advisory approach that is dynamic, interactive financial planning, helping you to identify strategies and solutions that we think will help you accomplish your goals. And as you work with us to help pull that information together, we work with you to try to find the best resources to make that happen. So while I'm going to start over here on the side, the fact is, in my opinion, everything starts with a return on life financial plan. But along with that, you would rest upon it in your personalized investment portfolio, which is how we create, or how you and I create and grow wealth. And then over on the other side of the pyramid, we have the personalized risk management solutions. And that's how we protect and preserve wealth for you and your family. And at the root of both of these is a return on life financial plan that identifies the direction you're headed to accomplish or achieve the destination you desire. And so these three components together create a solid foundation for making it possible to achieve those goals that are important to you. So as we've talked before, a fiduciary wealth advisory strategy requires a dynamic financial planning approach to create the best result. So when we put together a financial plan, we find that there's really only three curves that we're going to see for people's retirement. If we look here at the bottom, we're going to see a red curve, where that is somebody who they run out of money before they run out of life. Obviously, we don't want to see that, or we want to do everything we can early on to make sure we minimize that and maybe extend this out further. The other thing we see is a runaway green curve, where people who have more resources and are not spending as much as their resources can produce will just have this sort of geometric growth in their investments and their portfolio. But by far, the one we see the most often is a purple curve, which moves up and goes up to the point where maybe in our 80s, as the rising cost of living catches up with us, it will continue on over, maybe turn down a bit. A healthy purple curve can help create a gratifying retirement. Now, I would also point out that obviously the red is not going to create as much of a gratifying retirement, and I don't think that the green does as well. I think that having more and more wealth may help accomplish certain goals, but I don't know that anybody is going to say, oh, I am so happy I have all this money here. I think the question becomes, how could I do this better? How could I use these resources more wisely? And so what we do when we're working with people is, obviously, if we have the red curve, we work to help them plan wisely to bend that red curve up so it's closer to a healthier purple curve. And for those of you who maybe would be surprised by this sentence, we try to help those with a runaway green curve bend it down a bit, maybe so they could accomplish a few more things in life, maybe check off a few more things on their bucket list, so that, again, as they take that last few breaths of air on this planet, they will feel comfortable that they really did accomplish what they were called to do, that they feel like they achieved what was important to them, what was important to their family, what was important to their faith. So we try to help people in both groups get to a healthy purple curve to really make the most of what they have and to create that ROL that they desire. So when we talk about managing that red curve wisely, let's talk about what causes a red curve. The red curve is caused by our outgo exceeding our income and a lack of assets to offset that extra income that's needed. And so that calculation, if you will, more outgo than income and not enough assets to offset the difference is what would drive a portfolio down to that red curve. So really, when it comes right down to it, there's only a few choices we have. One, we could earn more on our money, which means we would take more risk. Or two, we might choose to save more money to have a bigger nest egg to work from in retirement. 3, we might choose to work longer before retirement to make sure that we didn't have to start drawing on the nest egg any sooner than necessary. Or 4, we might reduce our lifestyle before retirement and maybe even after retirement, or both, to make it so that the red curve is not a problem. And it's not really just one or the other. You can combine one or more of these to overcome the shortfall. And so in our planning software we use, what we do is we identify options for meeting the needs when we find a red curve is the outcome, the direction of that destination leads to a red curve. We look at some options. So for instance, one of those options might be save more before you retire. And in this example, we took a situation where the client ran out of money and had a red curve. And what we said was, if what the plan showed, the data came back and said, if they could find a way to save $300 a month or $3,700 annually, that would get them to that new level they need, so they wouldn't run out of money and they'd be able to achieve what their lifestyle is, and it would get them to 2069. That's a long time from now, but it would get them to 2069. It would just barely make it there, but it doesn't matter, because as long as it made it there, that's what counts the most. In this example, there wasn't really an earlier retirement opportunity, but in some cases, that would be what we could do. But in this case, what it is saying, if a person retired at age 65, the cost of their retirement, meaning all of the resources that they would need in this case, would make it so that it would work if they waited to 65. I believe in this example, they were looking at retiring at 60. So that fixed that problem. So if they waited a little bit longer to retire, that would fix that. And then the last one is they could reduce spending. We're looking for current lifestyle of $27,000. Now, before you think that that's the whole amount, the way the planning we work with answers this question is it identifies what are the liabilities that you have to pay. What are your savings requirements? What are your insurance costs? What are the taxes that you have to pay? And what goals do you want to meet? So it's those 5 things. And after those 5 pieces of information are satisfied, what's left is what we call lifestyle. So in this case, what's left after they've paid their taxes, paid off their debts, met the goals they wanted to accomplish, they needed about $2,000 a month to meet lifestyle needs. And that means like food, gas for the cars, going out to eat, and so on. It's just, that's where this column was. We see numbers that are lower than that, and we see numbers that are higher than that. But in this example, it's showing that their lifestyle, after they've paid their taxes, paid off their debts, accomplished their goals, etc., if they were to lower that to 20,000, then that would get them to 2069 as well. Now, obviously, a combination of any of these 3, working a little bit longer, saving a little bit less, maybe not having to lower the income so much, any one of these as a combination could offset that red curve. There's not a one size fits all. Some people would say, you know what, I'm okay to work to 68. That's not a problem. That just makes things easier that way. Some people would say, you know, I think I could save $400 a month. That also makes things easier. And some people would say, well, I could live on 25, but I can't live on 20. Or maybe if we do the recalculations with it, they might find they could live on 30,000 or 35,000 a year on the lifestyle only portion. The bottom line is taking a good look at these areas as early as possible can make it so that people can offset that red curve and be able to achieve the lifestyle they want. And that's part of how we help people manage through that red curve. Now, what about the green curve? Well, the green curve, as you can see over here, is caused by income exceeding outgo, along with an abundance of assets that are available for the future. And when your income is more than your outgo, and you don't have to pull money from your investments until later on when the cost of living catches up, it makes it so your investments have more time to grow. And the more investments that you have, the easier it is to make that happen. And again, I'd point out that while I think many people look at this and think, well, this is exactly what you want, my thinking is that we want to look at how we might be able to bend this down a little bit so that when you're in your 70s or 75 or 80 or 85, you can look back and say, you know, I enjoyed some of the things that I had. I didn't just work, or I didn't just sit around and do nothing because I didn't feel like I could, but rather you spent time with family or friends or doing hobbies or different items that were important to you. And so we take a look at how to bend that down and try to maximize ROL. So now, let me back up here a second. On this chart, this is what this couple's situation looks like under the current situation. But what we did when we're looking at maximizing ROL is we said, well, you know what? If you would withdraw another $7,500 per month, or roughly $90,000 a year, and you do that until you're 85 years of age, that would be right about here. Then maybe at 86 or 87, you might say, I just don't have the energy or the desire to go do some of those things anymore, and your wealth growth would take off again. Now, again, you might say, my goodness, $7,500 a month, that's a huge amount. Well, it depends on people. Some people, $2,000 a month is what they want. Some people, they need more than that. But the point is that if they don't pull that money out, this is what their curve is going to look like. If they do pull the money out and spend a little bit of it, enjoy it a bit, this is what it would look like. And again, I point out there's no guarantees that it works this way. I'm not suggesting to you that a calculator can guarantee what's going to happen in the future. As a matter of fact, when I look at this information, I really see us looking 5 to 7 years out in the future, and then recognizing that everything could be different down the road. So we take a look at how to create a model that makes it so clients don't have a runaway green curve, but actually are able to enjoy life a bit and maybe create more of that healthy purple curve. I would also point out that this is not looking at anything what we call stress testing, which I'm going to talk more about here in a second. Stress testing is taking a look at their situation and what if they have some catastrophic health event or somebody passes away prematurely. We'd want to make sure that before we just started running off and pulling out excess money to live life, that we had also considered what other issues might threaten family wealth or resources for your spouse, or if you have children that are dependent. We want to make sure that we thought all that through carefully so that we would be able to make a good, healthy purple curve that matches your life, your goals, and also protects you in the event something doesn't work quite like we'd hope would happen. Again, remember, the focus here is creating, growing wealth and protecting, preserving it. Why? For your future and for the future of your family. And so we use these calculators to identify direction so we can then see what kind of destination we're looking at. So again, keeping in mind that our goal is to create a healthy purple curve for our clients. And if they have a red curve, to see what we can do to bend that up as much as possible. And if they have a green curve, to look at how to bend that down so they could have some more ROL in their life. Now, with that in mind, I just mentioned a moment ago about stress testing. So let's talk a little bit about what we're looking at here. So when we're doing planning for you, what we do is create a baseline plan. And as you'll see here on this bullet point, a baseline financial plan is an evaluation of a person's income and outgo, as well as what they own and owe, extrapolated into the future to provide a trajectory of their possible financial destination. So we try to create the most likely result that we're looking at here based on their income sources, based upon their outgo needs, adding in inflation to recognize it's going to cost more to live in the future than it does today, taking a look at their assets, again, what they own, what they owe, their liabilities, and try to create a great model that is as realistic as possible to create a good baseline to say this looks like a reasonable expectation of today, the near future, and maybe where the long term goes. Bottom line is that you as client, you have to feel comfortable that what you're looking at isn't pie in the sky, but is actually something that seems realistic and relevant for your situation. And that's what we call the baseline financial plan. But once we have a good baseline financial plan, our next goal is to stress test it to see, well, what would happen if certain things happen? Some could be good and some would be bad. A stress tested financial analysis is a baseline financial plan evaluation identifying the impacts upon a person or family's financial life, considering some of the following issues. For instance, we might look at, well, what about taxable, tax deferred, or tax advantaged investment strategies or wealth management strategies, how that impacts family wealth. We'd look at loss of income. capital, or both due to a premature death or maybe a disability. We'd look at loss of income, capital, or both, maybe due to a health issue or a long-term care issue. We take a look at loss of income, capital, or both as it relates to property and casualty insurance, like car insurance and homeowners insurance, or maybe business issues that you're dealing with. In some cases, we're looking at achieving children or grandchildren's educational goals and how that's going to be impacting a person's situation. Poor economic or investment performance. What would happen if the markets don't perform as well as you and I would hope they would? Along with considering opportunities and risks if we're doing different types of investments, how would that work with your portfolio? Estate design strategies on future family wealth, as well as I would throw in there charitable design. For some of you who have charitable intent, there's some great opportunities we can do within this whole planning and stress testing to make sure that everything is matching your estate goals as well as your life goals. Business succession planning for those who own businesses, entrepreneurs, how does that work as far as moving out of their business into a redirection or retirement phase of life? And how would that look both short-term as well as long-term for them? And there's a lot more that we can talk about when you consider your ROL goals as well. So we create a baseline, much like that runaway green curve chart I was showing you, and then we take a look at how we could maybe bend that down to create a healthy purple curve, and then we take a look at how that would function if we stress tested it against some problems that could exist. By doing that, we can create a pretty good estimate or evaluation of where you're headed and what that destination looks like, and make some decisions on whether or not we should do some different adjustments today or tomorrow or sometime here in the near future. Along with that, once we have that plan in place, we also have a track to run on, because as we go down the road 3 years, 5 years, 10 years down the road from now, we can look at where we are today and make sure that what we expected to happen is on track. Or if something happens that really caught us off guard, how does that change everything? And so by having a baseline plan with a stress tested analysis of that baseline plan, it gets easier and easier to make longer term decisions, because you can see where you've been, where you're going, and then back test it to make sure that everything that you were hoping would happen was on target. And if not, if you're off track, we can take a look at what decisions make sense to get you back on track again. So by having that in place, it creates a healthier purple curve model to make decisions with. Now at the bottom it says considering your ROL goals. Let's take a look at that, because that's really very important. Return on life. Again, I mentioned a moment ago that ROI, return on investment, or ROE, return on equity, or ROA, return on assets. These are all very important components when it comes to managing wealth wisely. But in the end, that's not going to be as important to any of us as we take our last few breaths of air on this planet, as we're looking at ROL. What did I accomplish with what I had to make sure that I went and achieved what I felt called to do? And that's what this is about. And again, creating, growing, protecting, and preserving your family's wealth in today's economy is challenging, but with the right information, the right experiences, the right study, and the right people around you, it is possible to manage it well. I believe that the phrase from the good book says that plans fail for lack of counsel, but with many advisors, they succeed. And that's what we try to do, is figure out the best ways to help you succeed, whether it's with what we're doing on our part or helping you with other advisors that you work with. Now, when we come to retirement, I find that it's a hard thing for some people. Some people, they are absolutely ready to go, but other people a little more challenging. And so we have some tools called Retire Mentality. Retire Mentality helps people to start thinking through what they're going to do and what they want to do. And so on this particular piece of the puzzle, we look at your current life portfolio and then help to use this against what your desired life portfolio would look like. And we're not talking about investments, we're talking about using time and talent, not just treasure. So for instance, if you think about how you spend time with family and friends, how many hours a week or what percent of your time is there? Your work and career, again, hours a week or percent of time. Downtime, catching your breath a little bit. Sleep, we do need that. How about that? Health and fitness, spending time staying in good shape so you can enjoy retirement. And then personal growth, hobbies, learning new skills, etc. How do we do this with the roughly 100, well, it's not roughly, with the 168 hours that we have? How do we break that time up? And then if we stop for a moment and say, well, okay, this is what I am doing, how does that blend with what you desire to do? Because maybe there's other things that you want to spend more time with. Maybe there's more time with family and friends you'd like to spend, or maybe some downtime, or maybe health and fitness, or maybe personal growth items. How would you like to make this work? In essence, this is that first step in determining your ROL balance, your return on life balance, or what commonly called today your work-life balance. Because when you get to that place that you redirect or retire, you're going to have other things that you're trying to do. So what does that retirement mentality look like? What does your ROL look like? A way to maybe think about this is, what am I doing and what do I want to do? And by starting with that place, we can get people to maybe begin thinking about a few things differently. Now, one other piece that we add to that is envisioning your ROL. You know, sometimes we're so busy in the day-to-day that we don't have time to stop and say, what would I do differently? And so one of the reasons we use this resource is because it gives you a chance to stop and say, you know, if I could do more travel, if I could explore more, play more, if I could write, relaxing, teaching, going back to school, educating myself, mentoring someone, learning a new skill, developing a hobby, finish unfinished projects, maybe that honey-do list you're still working on, home projects, more time with your spouse, more time with family, more time with friends. Maybe you want to start a new business. Maybe you've been working in a career that it kind of meets the needs, but you really would like to do some more things. Start a new business maybe. Continue on your present course. Consult with the experience you have. Get a part-time job doing something different. Connect with a cause. Work for service, not pay. Volunteer. Get more involved in community. Take on a new challenge. If you were to go through that list and take those items and maybe check off 3 to 7 of them, and then go back to the previous chart where you say, you know, I think if I could use my time, those 168 hours a week, a little differently, this would be some of the stuff I would like to do. You might find that you're not moving away from something like a career or work, but rather moving towards something that really would maximize your ROL. When we have this conversation, I think most of us would know what I just said as your bucket list. What are some things on your bucket list you'd like to accomplish? What are some things that, again, as you get to that end of life, you want to look back and say, you know what, I'm glad I did that. This particular page is about considering your possibilities and saying, how would I do this different? Because once you start to consider your possibilities, and then you begin to say, how would I make changes? What would those changes look like? Now we can start to marry up the facts and figures of your financial situation with the feelings and desires of where you'd like to go. And that's how we can create a pretty healthy ROL thought process. So now, some of the final thoughts I'm going to give you for today. There are 3 curves of retirement that you could experience. One could be a red curve that runs out of money before you run out of time. Again, I would use the phrase there that if what you believe to be true turns out to be false, how soon would you like to know that? I know even just the very sentence of having that red curve, it scares people, and they're afraid that if they were to actually sit down and look at something, they might find out they have a red curve and they don't want to know that. But that's why I say the phrase, if what you believe to be true turned out to be false, how soon would you like to know? I suspect probably none of you on here have a red curve, but it would be good to know that if you did, sooner rather than later, so you can make some good decisions, some wise decisions between now and that point down the road. Some of you have a runaway green curve, and that happens if your portfolio is growing exponentially, which is what I showed you on a couple of those charts. That runaway green curve is awesome, and don't misunderstand. I applaud you. Congratulations, you've made a lot of good decisions to get to that. But in the end, as you saw on some of those charts, having 4 million, 6 million, 8 million, 20 million, that's not going to make anybody happy. What's going to make people happy is if they accomplish with those resources what they feel called to accomplish. And so we try to look at that sooner rather than later as well, so that people can make sure that they're on the right track. And to that point, that's one of the reasons why we stress test everything. Because again, if I said, well, just go ahead and start spending this money and enjoy life, and we didn't think about places you might need money, no, we wouldn't want you to spend or give away money that you really need unless we felt comfortable, you felt comfortable that you could still achieve the goals you have and still be able to accomplish your ROL without running out of money. And we want to make sure that we have a good plan for that. That's why we stress test that green curve to make sure that we're okay, you're okay. And then finally, a healthy purple curve that illustrates wealth growth while achieving your desired ROL. And that's really the sweet spot, I think, of what we try to do, is not have a red curve, not have a runaway green curve, but a really nice purple curve that meets your needs and makes it so you can accomplish what you're called to do. Right here, a well-defined return on life financial plan can assess your retirement curve and identify your family's current financial direction and possible financial destination. And that's really what we're aiming to do here, is to make it so that you know where you are and where you're going, so that that sentence I told you a moment ago, direction determines destination, really makes sense to you. Early planning can bend a red curve up toward a healthier purple curve. A runaway green curve can be bent down toward a healthy purple curve to provide more ROL for you and your family. ROL goals add your desires and feelings to the facts and figures that contribute to your family's financial future. And fiduciary wealth advisory requires that dynamic financial planning strategy to help you and your family manage wealth intelligently in today's complex economic environment. And again, as I've said to you in probably the last 6 or 7 months, it was a little over a year ago. Matter of fact, it's probably closer to 18 months ago that we started putting a huge amount of energy into saying, how do we really help people accomplish their goals? I mean, investing money is certainly one piece of that. Having protection to preserve wealth or protect wealth or income is another piece of it. But when you really start to think about me, or any advisor for that matter, trying to think like you think, trying to understand what's important to you, it just became glaring to me that having a dynamic financial planning strategy was going to be essential to make that work. And so as we began working with resources, spending time and talent, treasure to pull together the right resources to help you create that return on life financial plan, that's how I came to all of this discussion here today. I'm happy to tell you that the resources that we've put together, some of them have come from places where we spent money to put this together. Some of them have come from us listening to you to say, what could we do to help make your life work better, to help give you that confidence you need to make good decisions and go forward confidently. And that's what all of this is about. The website that I've been showing you now for probably close to 2 years, on our website, you can go on there and go to the login section up here, takes you to this page where you can get to your financial dashboard, which is the software we use to create the information that identifies the red, purple, or green curves. Your portfolio dashboard, that's how you can tell the portion that we're managing and how well that's working. Your risk reward evaluation, this is how we can tell that your portfolio is matching your risk to reward needs, both with us, what we call AUM, assets under management, and assets held away, AHA. So we can compare what your risk scoring is to any portfolio you have to determine if you're on the right track, if you're thinking through carefully what might happen, if it's going to work for you. That's how we do that. And then this last piece here, which excuse me, I'm laughing because today we brought on a new employee, and Stephanie was telling them that this is the part I like most, and she's not wrong. I love the other parts too. The facts and figures are important, but this is the part where we can start to take a look at your past, your present, and your future expectations to start looking at how do we achieve your bucket list? How do we identify transitional areas that are going to impact your finances, say in the next 12 to 24 months, to make sure that we're thinking through carefully how to help you create and grow, protect, and preserve wealth. So these four pieces together really represent the foundation to how we're helping people to accomplish return on life planning. There's other pieces that aren't connected here, but there are other resources that we bring into the conversation to help you understand what's working, what's not working. And I'm not talking about investments, I'm talking about other calculators and resources, tax planning for understanding the markets, and how to use tax advantage, tax postponed, or taxable accounts to create an efficient frontier for you. Those are all add-ons that we do with the planning, but these four right here, they represent the base that I hope you're all using. I know that some of you use them more than others, but these are the tools that we use to help you get the best out of what you're doing. So hopefully you're using them, and if you're not, please feel free to let us know. We'd love to help you use them more. So at this point, I've kind of come to the place for questions. I don't know if you have any questions. I really thought this would go a little bit longer than it did. I can see from the time I'm about 14 minutes ahead of time. So if you got some questions, I'm more than happy to answer those. If you don't have any questions, I'm also good with that. We can just go and have a great dinner and enjoy the rest of our evening, as I'm sure you'll do the same. But I'm going to take a moment here to say, if you got questions, just go ahead and go to the chat, online chat, and type those in. I'll be happy to answer those. Hopefully, though, whether you have any questions or not, tonight has been thought-provoking to help you understand, one, what we're trying to do for you, and two, to give you some thoughts on how what you might want to do could be different if you were using some of these resources. Now, our next wealth advisory review is coming up on June 13th of next month. I think that's the third Tuesday of the month. I will tell you right now that if the markets, we still won't be at the end of the second quarter by then. It's still going to be another month after that we're going to be looking at some of the data that comes together. If something interesting or catastrophic or challenging happens, we will spend more of our conversation in the next month talking about the economy and the markets and what we're seeing there. If we're still kind of in that holding pattern that I feel like we're in right now, we're going to spend more time drilling down on some of these other resources we're using to help you maximize what you're doing and to gain the confidence that you can utilize to go forward confidently. I think that was redundant, but you get my point. We're going to be talking about how to create, grow, protect, and preserve wealth, using those strategies to help your family. Take a look at market and fundamental and technical analytics, look at planning, investment, insurance solutions for you and your family, and then obviously take time for questions, which brings me to what we covered tonight. So hopefully the market and economic review at least gave you a little bit of confidence that if we're in a sort of a holding pattern right now, which really isn't true. We're never in a holding pattern, but it just kind of feels like things are kind of moving along slowly. Whether we're going to have a big recession, have a mild recession, a short recession, a long recession, or no recession, that's going to remain to be seen. But looking at where we are today, it seems like it's not going to be terrible, but we will wait and see. And I will update you as we find out more information. The three curves of your retirement journey. I know that some of you on here already know exactly what I'm talking about because we've had this conversation. Some of you, this is the first time you've seen this. Hopefully you understand more about what I mean with fiduciary wealth advisory, requiring a dynamic financial planning strategy, as I've been talking about this more and more over the last year. And on a side note, just so you know, I started in this industry back in 1986 with a company called Ameriprise, and we were doing financial planning even back then. But the resources we had available back then compared to what we have today, oh my goodness, it's like a Model T compared to cars today. It's that different in what we're doing. And so at different times we've used planning more aggressively, but at no time have we used planning as aggressively as we are today. And I think that has a lot to do with the economy and where we are and so on. Hopefully my final thoughts gave you some food for thought as well. And the wealth management resources that we have available, hopefully those will help you with making the most of what you're doing and giving you that confidence that you need to go forward. I see that we have a few questions. I'm going to take a moment for that. And then we just covered when the next advisory review will be, which will be June 13th. Let's see here what we got for questions. Okay. I missed the first part of the session. No worries, Carol. Yes, you can see it. And I'll tell you what, we are loading all of these onto the website. And then what we have to do, just so you understand, is we have to turn it over to the editors we're using, and they then take and put it together into a package. We forward that to the broker-dealer, and the broker-dealer reviews it and approves it. And once they approve it, we can then put it on the website. And I'll make a note here, Carol, that we send you a link right when it's available, so that way you can watch this as well. But I would also say, Carol, you don't have to wait till the video. I'm here live in person. You can come see me, and I'd be happy to sit down with you and Terry and talk more about this as well. As always, if you would like to invite your friends to our updates here, you are more than welcome to do so. All you have to do is let Kayla know, and Kayla will be happy to send them a special webinar invitation. Then they could come and join on here. Hopefully by now you know that they're not going to get any pressure from us to meet with us or anything. They are welcome to sit here and listen and learn for as long as they need to. And then if the day comes they do want to talk to us, we'd be honored to talk to them because they're your friends. Which brings me to another thought. If you have anybody that you feel like could benefit to talk to us, we'd be honored to help them, primarily because they're your friends. And so if you have somebody in mind, you can let us know, and or let them know and have them reach out to us, and we'd be happy to talk with them as well. Let's see, we got another question here. All right, thank you, Stephanie. She's helping people with their stuff, the technology. All right, so we'd love to have you join us at our next Wealth Advisory Review. And then again, if you have any questions before then, you certainly feel free to reach out and let us know by email or by phone. If you want to come in, sit in the office and talk, or you want to do a webinar with us, all of these are available. We're here for you, and we are certainly interested and glad to help you anytime we can. I think that's everything for tonight. I don't see any other questions. So as I always say, I've either told you everything you need to know, or I've confused you so much you don't know what to ask. Hopefully it's not that last one, but if it is, feel free to email me tomorrow or the next day, and I'll be happy to answer questions as well. So right now, I think I'm going to head out, go get something for dinner, enjoy the rest of my evening, and I hope you do the same as well. Have a wonderful evening, and I will look forward to talking to you soon. Again, oh, I also forgot to say, if anything happens that I think is crazy, we will offer a webinar or an advisory review before that. So don't hesitate to think that we'll miss that. We'll be here sooner if we need to be. If not, I will see you on the 13th, or if I have a meeting with you planned soon, I'll look forward to that as well. Until then, have a wonderful evening, and God bless. Bye-bye.